UiPath for us also on the earnings front as a stock that was pretty popular for a while last year, George, and then just, hit the wall middle last year.
Yeah, I mean, obviously the company's not doing well. If you look at it going back to May of last year, there was a huge gap on earnings to the downside, and it's been in a trading range since then. And it looks like in the after hours, it's giving back some additional monies around $2 a share. Based on earnings, if you look at it, it's just kind of a tricky one to evaluate, but they did post a better than expected EPS. The estimate was around 20 cents a share, give or take a penny, and there was an adjustment. The adjusted earnings that came in were 26 cents as denoted by the company. So that was actually a surprise beat and actually an increase compared to 22 cents last year. So going into the quarter, they were expecting to be down about 13% in earnings compared to last year. And sales did come in shy of estimates by about $1 million at 424 million versus 425. But nonetheless, that was still up about 9% compared to last year. They did denote, average recurring revenue exceeds the total revenue by about $200 million, around 1.66 billion, as well as net revenue retention rates at 110%, gross margins 85%. And one of the things about the business too, it's got a lot of cash, 1.7 in cash, $billion compared to 6.4 billion in market cap. Very negligible amounts of debt to consider even being worthy of mention, but they did make an acquisition. So I think that is adding additional pressures. And I haven't seen the details of the acquisition. It looks like they're acquiring a competitor in the UK called Peak AI, which is an inventory management AI business to kind of go along with the workflow automation business that UiPath is actually investing in. So one of the things I looked at is it's very high gross margin business at around 84%. Now they denoted for the full year 85%, but they're still not profitable on an adjusted basis, even though on a GAAP basis, forgive me, meaning on a non-adjusted basis. But on an adjusted basis, there's sort of that disparity of adjusted profits versus unadjusted. And as time goes on, if you don't close that gap, they start to become wary. What I mean is the institutional investors of the underlying business. So not necessarily a good quarter, I would say, potentially because of the sales miss. Guidance also, if you look at that, was down just slightly. It looks like the fiscal year numbers were around 1.58 at the midpoint $billion, and on the high end now they're guiding for 1.53 as well as slightly down for our next quarter's revenue as well.
Okay, so it doesn't look like this is going to be necessarily an obvious path to relief. Looks like the opposite, coming off $2, almost $3 in the aftermarket. That's ugly.
Yeah.
Doesn't look like a good report. Thanks, George.